It's Christian Thwaites from Brian Janikowski calling Monday, February the 5th, 2018. And as many of you will be seeing on your televisions and the news and the streaming media, we've had a weak day in the markets. How weak? Well, the S&P was down about 4%. The Dow Jones, which those of you who read our blog will know that I'm not a fan of that index because of the way it's skewed towards high priced, is down a little bit bigger, but that's almost entirely because of Boeing. And we saw a big spike in the VIX index, the so-called fear index, which went from about 12 to 15 to as high as 30 on an intraday level. Again, I'm not a big fan of the VIX index. It's implied volatility. Won't worry about exactly how it's calculated, but really only take notice of about 20. So we did take notice of it today. And it does show that obviously there's a little bit more risk and risk-taking going on in the market. And then also, we've seen emerging markets and international come off a little bit, not as much as the US markets, although we might see some more action overnight as they react to the closing of the US. And interestingly, 10-year US Treasuries were rallied, so they were up about 2.85% on Friday's non-farm payroll numbers, and today they rallied and they came in at about 2.71%. So that's about a 50 basis point price increase in the corresponding 10-year Treasury. So that's what's going on in the markets. You'll hear a lot of noise about record numbers, points on the Dow. Obviously, we are going to see big numbers because the Dow is so much bigger than the last time we had a big 500-point correction, which was in 2015. And you'll hear a lot about the end of the end of the equity bull market. But so why is this going on? Well, I think there's primarily four reasons. First of all, the market is very overbought. Even today, after today's correction, we're back to where we were in mid-December. And remember, January was essentially up, 2017 was up essentially 20%. So a lot of people made money. In fact, almost everybody made money in the markets, and the markets were slightly overbought. And I think people were looking for a reason to sell and a reason to take profits, and this was offered to it. This is a market which is more driven by concern about the strength of the economy rather than fear that something coming bad to the economy. So it's very different from 2008. We had good ISM numbers from the manufacturing, and today the service numbers, very, very strong numbers, which suggest that the economy is doing better than people anticipated. On Friday, we did see the new non-farm payrolls. There was nothing to write home about in terms of the numbers of jobs. It was 200,000, but there was this number tucked in the back, which showed that hourly average earnings had risen on an annual rate of 2.9%. I personally don't think that's going to be sustainable. It'll come down a little bit, but it was enough to get people to think about, well, if wage inflation is coming through, then price inflation can't be too far behind that. So we'll see whether or not that's going to be a lasting trend. But with my experience and what we're doing, I wouldn't bet on it. The other thing that we're seeing is classic moving of stocks in the 2 to 4 o'clock period as markets close. And that's typically very indicative of margin calls coming in. Again, that implies that there's a lot of leverage money and an overbought money and people looking to take profits. So there we are. So what do we do next? I think actually the indicators for the economy continue to be quite good. Stocks don't typically have big corrections if the economies are doing well. We mentioned ISM. Today we saw something called the Senior Loan Officers Survey, the SLOOS report out of the Fed. That was actually very encouraging. And you don't usually see if companies are lending, banks are lending more to corporations to expand, that's not usually an indicator of something bad around the corner. Also, the earnings are coming through pretty well. There are some strange earnings being thrown out. Google, just as a result of the changes in the tax accounting, actually reported a quarterly loss, GAAP loss on Friday last week, which is crazy. I mean, it looks like it lost $12 billion. It didn't. It did continue to make a lot of money, but the earnings are throwing out these rather sort of strange accounting requirements, and it's looking as if, and then it shows up in strange valuations for the market. So we are still very quality biased in our approach on U.S. equities. Remember, we've always liked the high dividend, growing dividend payers, the companies with the strong balance sheets who won't be hurt by an increase in interest rates. We've got the emerging markets and international, which are doing well. We're not particularly bullish about the dollar, so that translates into good gains there. And we're going through this rather big juncture in the bond market, which we think will settle down as markets get a little bit more used to what's going on with this stronger economy. So, as always, stay the course. This is not a time to be selling or taking a strong action. In fact, this is a time to kind of stand aside from the rush as we see some of these corrections going on. I wouldn't be surprised to see some program trading coming to the fore the next couple of days as companies are essentially some investors, particularly hedge funds, are going to be forced sellers. But I think we're seeing far more concern and fear at the public level than down on the ground with investment. And we just say stay the course, and this is a normal and indeed healthy correction. We'll continue to update this, and please check in with your financial advisor if you'd like more information. We'll continue to update our website. Thank you very much.